Once you've added up all of your income, you now have two pathways to choose. You can either get the standard deduction, let's just say married filing joint, $31,500. This assumes you're under 65, married filing joint, whatever. And then pathway 2 is itemize. Which pathway you choose is going to be whichever one gives you the most tax savings, whichever one's the bigger deduction, right? So then you have to ask, well, what things can I itemize? Things that are on that list. The big 3, mortgage interest on up to $750,000 of mortgage on a primary residence, state and local taxes, which before this bill, they were capped at a $10,000 maximum. So you could pay $100,000 of state and local taxes between property taxes, income taxes, whatever it is. You only got to deduct $10,000. And then charitable. Like those are the 3 big ones. There's a couple of others, but those are the 3 big ones.
We were talking about the issue of echo. So how unsettling it is to not only just see yourself, but hear yourself talk. So it's very unsettling. Remember when Zoom first came out and you had to actually be in a digital meeting? You remember? Was it off-putting for you?
No, because in my career, I started out meeting clients virtually. So what was so funny was that when I actually went to UBS in 2020, I thought that I was now going to be going from doing virtual meetings to doing in-person meetings. And within 2 months of getting there, the whole world shut down. And I was back to doing virtual meetings. And it was ironic because I had done thousands of virtual meetings up to that point, and the other advisors had done like 0.
Yeah.
Right. So it was a total.
So you were already
role
used to
reversal.
it.
It was a total role reversal. So I don't know. I feel like I kind of live. I mean, for the clients that I work with, the vast majority of them, we just meet virtually over Zoom.
Well, I'd say it's about 50% for me. But when Zoom first came out, actually it wasn't Zoom. We used GoToMeeting. That's an ancient software. Actually, we still have a GoToMeeting subscription because we run our VoIP through LogMeIn, which is who makes GoTo. But it's a terrible product. It doesn't work as well. It's kind of clunky to use. But that's what we originally started with. And I remember the first time I saw myself on camera, I couldn't hardly think. I was like, I don't like that. I don't like seeing myself. But now I've gotten used to it. So it's not an issue. In fact, now I find myself when I'm in a Zoom call, I will be looking at my own video feed almost as much as the speaker. It's a little bit narcissistic. I catch myself like, why am I paying attention to myself? And I do it because I like to, it gives you immediate feedback on your like body language, so you can see how you're presenting yourself. And it's actually quite informative. But I remember at first it was very, very unsettling. And that you get that same sense when you hear yourself talk. To date, I still have yet to listen to one of our podcast episodes because I'm like, I don't want to hear myself.
Well, I know that when I started in this field at Fidelity, you were working with clients a lot of times over the phone, and inevitably the management for compliance purposes had to review phone calls. And so you would just periodically, a couple times a year, you'd get a Skype and you'd be on some other phone call, and all of a sudden your boss is Skyping you and says, hey, come over to my desk when you're done with that call. Yeah. And you just knew there was nothing good that's coming of this, right? So like you're not going over to their desk for a pleasant conversation typically. So of course you go over to their desk and they say, look, put these headphones on. And it's just everything. I think it's so interesting, right? Because some of the most beneficial things to do for yourself are also some of the hardest. Like sitting down next to your boss at 25 years old and putting headphones on to go listen to that phone call that you already know what you did on this phone call. And as soon as you hear what phone call it is, you kind of know where this is going. And then you have to kind of sit there and listen to the train wreck. It's a little scarring in some ways, but it's some of the best maybe ways to train yourself.
Well,
Because
how else are you going to improve?
so I think for me, I'm like you. I don't like listening to myself, but I think it's an important part of
Yeah, it's
self-improvement.
necessary. But we had major echo issues with that other that other product that we're looking in. So
Yeah,
hopefully we'll
if
have
you've
it.
ever been on the phone and when you talk into the phone, you hear yourself echo
Yeah.
back at you,
Mhm.
it's that kind of level of distraction when you have these
Yeah, and
headphones
you just
on.
can't talk. We got a lot of big things to talk about. We got the big beautiful bill. We're gonna release all the dirt on the Epstein files.
Well, look, we've got there's actually a lot going on right now. We've got
Yeah,
a ton of crypto
I know.
legislation
Yeah,
that's moving through the government. We just got passage of the big beautiful bill, big AI infrastructure announcements, inflation numbers out this morning.
yeah. So we got a lot to cover. We don't need to be distracted by an echo. So stay patient. We'll get the video out to you here shortly. Probably next episode we'll have all the bugs worked out, but stay tuned. We look forward to doing that, and then we could have a formal introduction to the audience. Well, with that said, maybe we should just break into it. So, welcome to the Money Alchemist podcast. I'm one of your hosts, Ben Jones.
And I'm Brent Gargano.
Yeah, and Brent's already introed what we really have teed up today. But before I do, so since the last conversation we had 4th of July. So I want to know, like, what did you do?
We went to the pool.
Yep.
I'd say we took the
You
family.
and probably half of the nation.
Yeah, we have like a sports club that we belong to, and
Okay.
they had inflatable bounce houses out and
Was it
cool
crowded?
stuff. Not as crowded as it's been in years past.
Yeah.
So, but keeping the kids. So, I grew up in the Carolinas,
Mhm.
and in North Carolina, even in the summer, you're pretty far east in the Eastern time zone. So, like even summertime, it's like the latest it gets dark is maybe like 9 o'clock, give or take.
Mhm.
Here in Cincinnati, it's different. We're the almost as far west as you can go in the Eastern time zone.
That's
So
right.
this was great when I was in high school because I got here and I realized that it stays light until like 10
Yeah.
at night
Yeah.
and
And you
some
love
days in the
that.
summer, and it
Yeah.
was great. Now that I'm a parent, I'm definitely facing payback for that because my kids, I try to get my kids to go to sleep,
Mhm.
and they're like, but daddy, it's daytime.
Yeah. For another 3 hours.
And I'm like, it's daytime at nighttime in the
Yeah.
summer.
Yeah.
So that is all to say that we had to keep the kids up till 10 o'clock
Mhm.
on July 4th, and
And there were pills.
they were crazy,
Yeah.
just absolutely nuts. Which we love our kids to death, but yeah, they if you keep them up a little too late and
They
they're a
turn
little
into
too worn out,
gremlins.
they go nuts,
Yeah, they do. Yeah.
screaming, crying all over the place.
Yeah, we kind of have a late bedtime for our kids. We're a little bit unusual. I find that a lot of parents, a lot our age, they love to put their kids down at like freaking 7 o'clock, something super early. That never happened in my generation.
Because you want time.
Yeah, I
It's
get
really
it.
not about the kid.
I know. That's exactly what it is. It's a selfish thing. So I know you parents that put your kids down at 7, 8 o'clock. I know what you're up to. Don't tell me you're early risers. Give me a break. Our kids go down. We start the bedtime process during the summer at 9 o'clock. Usually our kids are asleep by 10. All right. So, and people were like, oh my God. Yeah. But that's what we do. During the school year, we push it forward an hour. So our kids start going down at 8. So our kids on 4th of July were fine. We didn't have any crying. But my brother and sister-in-law, on the other hand, their kids, oh my God, that was problematic. I know exactly what you're talking about. They were fussy and, just very, how do I say this? Like, without being cruel to them.
Well,
They were
what
very
I found
touchy.
funny is like my kids
Yeah.
are all excited for the fireworks.
Yeah.
It comes time for the fireworks, and
Mhm.
then I can't keep them in their seat to watch the fireworks.
Yeah. So
Like
they're bouncing all over.
they're running around doing others, and I'm like, guys,
Yeah.
this is what we were here for.
Oh yeah, but they'll remember it. So here's my 4th of July story because it does touch on one of the things that came out today, which was inflation. All right. So remember all this talk about tariffs. Oh my God, tariffs are gonna crank up inflation to something numbers you've never seen before. All right. So most fireworks are manufactured in China. As you know, the tariffs in China were, I think they're 30%. There was no tariff holiday for Chinese goods. So, tariffs were immediately applied to Chinese manufactured goods imported into the U.S. All right, so every year I go to Rozzi's Fireworks in Loveland, which is a phenomenal place to buy fireworks. Just to plug there, they don't pay me anything to say that. They're just great people. They produce great products. So I go to Rozzi's every year, and I'll spend anywhere between $700 to $1,200 depending on my appetite for fireworks. So this year I asked the people at Rozzi's, like, how have inflation impacted your prices, and they said not at all. So their sales were through the roof. I actually ended up buying previous year. I bought about $850, $900 worth of fireworks. They lasted me about, I put together like a 30-minute show. This past season, I bought $900 worth of fireworks, so about the same amount. I ended up getting like 25% more in terms of time to light up the fireworks. The haul was about a little bit bigger. So I found that the tariffs had not only no impact on the inflation, but I actually found that I got more for my money. Now, that's not necessarily true for all products and services, but I do think that now that the tariffs have been applied for a little while, now not all of them, because as you know, the holiday, the tariff holiday, or what wasn't called a tariff holiday, it was called a tariff pause or whatever.
90-day pause.
90-day pause that ends in August. So
no, it was supposed to end this week.
Oh, really?
It got extended.
Oh, got extended again. Okay.
Right. What do we?
It's all a game. What are we doing here? But the fact is that tariffs don't have a direct one-to-one impact on inflation. So, the tariffs are definitely a tax drag. I'm not saying that they're good. But what happens is when you get a tariff that is applied to a good or service, it basically makes its way through the manufacturing process. So first, the first person to get impacted by tariffs are like the commodities producers. They eat a little bit. Then it goes to the manufacturers, and then they eat a little bit. Then it goes to the distributors and the retailers, and they eat a little bit. By the time it gets down to the consumer, most of the tariff has already been absorbed. Sometimes all of it has been absorbed, which is the case with these fireworks.
Yeah. How many times can you divide 30%?
Yeah, quite a bit. But the bottom line is, like, I think that the impact of the tariffs were overblown by markets in the first half of the year, which is why we're now at all-time highs in U.S. markets.
You know what I find so funny? Mm-hmm. Inflation is probably, of all of the economic data points out there, I think it's the most political.
Mm-hmm.
Like, in my career from 2010 to 2020, like, inflation as measured by the CPI was like nothing.
Yeah.
Right. But like all of my, and I'll just pick on my conservative clients, all of my conservative clients, well, might say it's 1.5% inflation, but have you seen the tub of ice cream how it's gone
it's
down?
It's always steak. Have you seen the price of beef?
Well, for a long time, the answer
was
they're not inflating the price. They're shrinking the amount of the good.
Shrinkflation.
Right? Shrinkflation. That was the story for 10 years. Now we actually have even today, the inflation number this morning, year over year, was 2.7%. So from this time last year to this time this year, prices as measured by the basket of the CPI basket, up by 2.7%. And you have a bunch of, and there's big drama over this right now. Jerome Powell is in a little bit of the hot seat.
Yeah.
For some context for the listener, so the Fed controls interest rates, at least short-term interest rates, and they use these controls to either stimulate the economy by reducing interest rates and making the cost of money cheaper, or increasing interest rates and making money more expensive and thus slowing the economy. And a couple of years ago, when inflation got really hot, they needed to pump the brakes. And so they jacked interest rates higher. Since then, there's been a lot of conversation about reducing rates, very little action. We actually got, at last September, almost a year ago now, the Fed dropped rates. Jerome Powell, being the leader of the Fed, the chair, as we call him, dropped rates by 1%, but longer term interest rates actually went up.
Yeah, so mortgage rates went up.
Now the Fed is in this weird spot where inflation is higher than it was. 2.7 is a lot higher than it was 5 and 7 years ago,
Mhm.
but it's dropped pretty meaningfully from the 9% peak. And so there's this growing debate of like, what is Powell doing? Every time we hear from Powell right now, he is talking about being patient to see the effect of the tariffs on inflation.
Mhm.
And that's kind of been the story. I mean, I think we've all been waiting to see the effect of these tariffs and inflation now since what, April? And we're like 3 months of data into this. And really, we haven't seen much yet. And so there's this growing um, kind of, fo- there's this growing
Pressure. It's a pressure.
pressure. Yeah,
Yeah.
there's this growing pressure to push Powell to drop rates. And I think it's really, I don't know if, as an investor,
Mhm.
like the last couple of years have been characterized by stubbornly high rates, right? The
Yeah.
Fed has not cut rates, but it's been because the economy is stubbornly strong.
Yeah.
And I think I would rather have a strong economy with the Fed less likely to cut rates than have a weak economy with a Fed cutting rates.
Well, yeah, and it also too eats up. So think of these interest rates like like an ammo clip. When the economy gets in a tough spot, the Fed likes to dump the clip to you know to tame the recession beast. Basically slay it. If you start cutting rates in a growing economy, that leaves nothing left in the ammo clip, and you have nothing but quantitative easing to combat a declining economy. So I believe that the Fed is doing the right thing. I think that the reason the current administration wants interest rates reduced is because they want their bags to pump more. I think that they know if interest rates go down, then that's going to divert even more capital into financial markets, which is going to make a lot of things go up. Now, I necessarily don't believe that cutting the federal funds rate, which is a short term overnight rate target that banks pay and assess one another in the overnight lending markets. So, it has nothing to do with long term fixed income bonds. Now, the Fed does impact long-term rates through open market operations, but that's not what we're talking about when we talk about rate cuts. What we're talking about are short-term
Yeah,
rates.
we're talking about essentially what you're getting paid on your savings account if you're a
Essentially, yes,
consumer.
and short-term T-bills to a certain extent.
Any floating rate
Yeah,
loans, which is what a lot of businesses borrow at.
yeah,
So that's maybe a little bit further in the weeds that we need to go. But the
mhm,
point is, we have the same people here that were complaining about inflation looking artificially low when it was actually higher that are now talking about, inflation is gone. Why are you worried about inflation? And
mhm,
I don't know. I mean, I think only time tells. I mean, it's hard to pull out the crystal ball and pretend that you have certainty, right? I think one of the roles of a financial planner is really acknowledging that there is no such thing as certainty. You could always be wrong, and you've got to be kind of ready for that. And I think that's what's driving the Fed right now. Is I think there's probably a lot more benefit in their mind to holding on and being a little less aggressive than cost, right? And you just have a lot of people when Powell gets out and when Powell gets out and what he's been basically the citation he's made for why he's not dropping interest rates is he's waiting to see the potential impact of tariffs on inflation. And so this is kind of politicized Powell's role,
mhm.
probably more than he would like.
Yeah. Oh, yeah. Now, I've never believed that the Fed is not political. I think it has to be political. Whenever really show me a agency or department or even like the Fed's supposed to be independent of the government. Like everything's political. Even corporations are political. That's why they have lobbyists in Washington. So, politics are just a fact of life when you're playing at any level, especially the highest levels of our society. But really I don't want to spend too much time talking about the Fed because we've got the big beautiful bill that we need to be talking about. Bottom line is, you and I both believe that the Fed is maintaining rates is probably a good course of action in this political pressure that Jerome Powell and the rest of the board is feeling to lower rates. Really isn't I don't think it's I think it's coming from a place of of short-term thinking. So, it's not really I don't think it's a long-term healthy for the
I just think you got to be careful what you wish for.
Yeah,
You know,
exactly.
I
Yeah, that's
mean,
a good way to put it.
if you get
Mhm.
rates dropping, the second degree question after that is, well, what are they seeing that's causing them to drop rates?
Mhm.
And the answer to that is, put kind of simply, softening economy. And just like I said before, I think I'd rather have a stubbornly strong economy
Mhm.
with rates that are stubbornly high than have an economy that's getting the benefit of rates dropping, but it's because the economy is really softening. So I agree with you. The Big Beautiful Bill Act, right? So
Mhm.
the what is this? The OBBBA,
Oh,
the
bu 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 bu.
OBBB is, I think, how I've how it sounds out phonetically. So the bill passed. It was very patriotic, right? The 4th of July, on the 249th anniversary of our country, I believe, and it signed the Big Beautiful Bill into act. And I think there's something like 10,000 pages in this bill. Is
Yes.
that right? You
Yeah.
read all 10,000 of them, I'm sure.
Oh, everyone. Yeah, every last word.
You spent all of last week basically having Grok scan it for you, I'm sure.
Pretty much. Well, I read a couple articles. I think that you've also learned up quite a bit on it, and we've distilled down the important points that will impact most people. As with any omnibus bill, there's just a lot of like stuff in there, a lot of what they call pork, um, that really is going to go underneath the radar, and you'll never even know about it. Never knew it exists until one day it just pops up out of thin air, or maybe it never does. But the major cornerstone portion of the bill is the tax legislation, and believe it, if you're listening to this, it has impacted you. There's not a single person unless you are just actually no, even if you are just born, it impacts you because if you're just born, now you've got these things called Trump accounts. Is that the real name that
Yeah,
they're actually called Trump accounts?
I believe so. I remember originally they were going to name them something else,
Yeah.
and they were going to name them MAGA accounts. That's what it was.
The amount of derision caused by that name is pretty legendary. It's going to go down in history books. So the fact that they called it by the name of, used the term Trump, I think is a little bit I don't know, salt in the wound for half of the nation.
Well.
So,
There's good news,
yeah.
which is that the long story short is
Mhm.
there's probably better ways to be saving. I mean, I'm not saying that you shouldn't. But
Yeah.
it
Mhm.
turns out, as we've gotten more clarity on these, that the Trump account does not grow tax free.
Mhm.
So you can put money into this account and it can grow, and it's tax sheltered while it grows, meaning that if you sell something at a gain or if you get a dividend, there's no tax on that.
Mhm.
But when your kid goes to pull the money out, they have to pay some form of tax depending on how they use it. And for us in the financial planning community, that was really kind of a letdown because if you compare that to like a 529 plan, which is traditional college savings, okay, that money's maybe a little bit more restricted because you're supposed to be using it for college, but it comes out tax free. And there's other ways that you can get the money out. So I was a little disappointed to see that the tax benefits of the Trump account not as strong as I would have hoped. And then, but that said, I mean, you do get, if you have a kid
Mhm.
this year, next year, I think it's 3 years, right through 2028, you get seed money.
It seems unnecessarily complicated, though. I don't necessarily see how these accounts for as a long term solution for saving for your child are any better than a custodial account or a 529 account. For those of
Yeah,
you
where I can
wondering,
pay long term capital gains rates anyway.
yeah, for those of you wanting an in depth discussion on those two, we do have a podcast about it. What we call investing in your children or next generation. I forget the name of the episode is, but it's a couple episodes back. But I don't see how these Trump accounts are better, except for one thing, and that is they provide the seed money. So what's going to happen is most families that get this seed money, they're just going to withdraw it. They're just going to get it and they're going to withdraw it and they're probably going to spend it on medical bills. or whatever, diapers. So I think it just seems like an unnecessary, cartwheel in order to do what should have been done, which is just give them a baby bonus on the tax return.
Yeah.
You had a baby, here's $2,000, there you go. I don't understand why you got to go through this whole rigmarole because, it really doesn't improve on anything it just further complicates things. And I think that's, for not all the bills this way. So I sound like I'm griping, and I'm not I'm actually pretty excited about the tax provisions in this bill, which we'll get into the positives, but I'm going to just gripe a little bit here about this legislation and all legislation. It's like, why is it that these policymakers feel so compelled to make things more complicated?
Yeah.
So another thing,
this bill definitely increased complexity.
oh, for sure. One other example is for those of you listening, we made a call a while ago, and I regret making this call because it ended up being accurate that Social Security income would be tax free. That is not what happened. In fact, what they ended up doing. So one thing that I always gripe about Social Security is you pay income taxes on your FICA taxes, which is the tax that you pay for Social Security. That's your FICA tax. Well, it also is Medicare too. But then you pay taxes again on that money when you receive it as income. Now it's treated tax favorably, which I'm not going to get into, but it basically creates a very complicated situation for retirees.
Well, and here's what it is, right?
Mm-hmm.
And I agree with this, and I think we should back up and maybe break the bill down a little bit. But just while we're on this topic, I do agree. There's so much complexity for people that are drawing Social Security and over 65.
Mm-hmm.
You look at Social Security, and to boil down the taxation and that favorability, quote unquote, on Social Security is Social Security is not fully taxable. The more money you make, the more of your Social Security is taxable.
Mm-hmm.
So as a retiree, you have to think about, well, okay, for the first bit of income you make, not only are you paying income tax, but you're now phasing Social Security into taxation because every dollar you earn is pushing you higher in income, and thus more of your Social Security is taxable. Now there's actually another threshold higher where if your income hits 75,000 single or 150,000 married filing jointly, you start phasing out of this additional
It's a $6,000 standard deduction on top of your standard deduction. So
and this deduction was put in place kind of in lieu of no tax on Social Security. But as great as it is to say, hey, here's a little bit of money back, they actually introduced another phase out for retirees.
Yeah, it's not, I don't think it's an olive branch. It's like, here's another complicated calculation. It's so, the amount of stupidity required to put this in there, all they had to do, Brent, was inflation adjust the income threshold for which Social Security taxation would be applied. That's all they had to do, which currently for married filing jointly, I think there's a tax, they call it provisional income. If your provisional income is over a certain amount, then a percentage like either 0%, 50%, or 85% of your Social Security is taxable. And I think for that 85% to kick in for married filing jointly, which most people file for that under that filing strategy or filing method, it's $44,000. So,
right, so it
but
doesn't
it's not
take a lot of income.
But it's not inflation adjusted. It's been that way. It's been $44,000 since 1984. And it's like all they had to do was inflation adjust that. Problem solved.
Yeah.
But
instead, now we have the same phase ins for Social Security tax. So for every retiree that I work with, we're looking at where they are. Are they already fully phased into Social Security taxation? Do they still have room to be phased in? What does that mean for their true tax rate on income? And then now you have this new phase out at higher levels where now I phased them fully into Social Security taxation. Now I'm phasing them out of this extra deduction. And it just, you add, the complexity of RMDs, which the rules have changed like 4 times in the last decade on how RMDs work, the complexity of timing your Social Security, taking your Medicare premiums being also driven by income. It's like, there's no demographic that the retirees, even in a simple situation, there's just so many cross currents impacting their taxes. Yeah. And I think if you bringing this back to what we do as advisors, one of the biggest benefits over the last few years to the advisory work is the introduction of tax planning software. So like in our practice, we use software to project out people's tax returns. So in my practice at this point, we've gathered pretty much all clients' 2024 tax returns. And now we're starting to build out 2025 scenarios with some assumptions based on how 2025 is going. And within that, we're able to actually visually graph out those tax rates at different levels of income and see it, because it's so hard to keep track. Like, I know that in my past life as an advisor before the tax software, you just kind of look down at the tax brackets and say, okay, well, here's roughly your income. Here's where you're at, mindful that, yeah, you might be pushing more into your social security. You couldn't really be prescriptive around it. You were just kind of talking in generalities about where the brackets are. Now I can take a client, and as long as I've got an accurate tax projection, I can go run a calculation and say, okay, well, how much room do you have in this bracket, or before the next Medicare surcharge threshold, or before you start phasing yourself out of, the special senior deduction, or any of these things. And I think that becomes even more critical, just because, and all we've talked about at this point is the retiree, the special $6,000 deduction. But there are other things that were introduced with this bill that create kind of quirky tax nuances.
Oh yeah, we'll get into those.
So let's talk about what the bill was in high level.
Well, just let me summarize this point, and that is, if you're filing for Social Security, or if you filed for Social Security, receiving Social Security, especially if you're over 65, congratulations, you now need to hire a tax planning advisor. So it's good. It's good business for us.
It may very well be worth some hard dollars, because we talk a lot about the value of an advisor in an emotional sense. I think our last episode we talked about the value of a financial plan, and there's a lot of emotional value there. But taxes, I mean, it's the one place where I can look down and I can point at thousands.
You're going to walk away ahead after you pay the fee. After you pay the fee, you are most likely going to save money on taxes more than the fee. That's just the way it is now because of the complexity. Now, let's talk about the other stuff. So one thing that seemed a little bit gimmicky to me was that this whole campaign promise on no tax on tips, no tax on overtime. I was actually pretty excited about it. I like that idea, but it seems to be nothing more than a political ploy, because I noticed that these things were phased out after 3 years. Interesting timing.
Well, so here's let's back up a little bit though. Okay. So we've talked a lot on this podcast about taxes.
Yeah.
I'm going to reiterate the history lesson. So in 2016, Trump is put into his first term as president. One of his first pieces of legislation was this, the Tax Cuts and Jobs Act
of 2017.
That got passed. 2017 comes whole new tax system. Dramatic changes from the tax system before, increased standard deductions, more favorable tax brackets, right? The problem was, in order to get it passed, they had to create an expiration date on it. It was set to expire next year. And so politically, the reason they wanted to do one big, beautiful bill right now is that I think they knew they could put everything they wanted in that bill.
Yeah.
You've got 10,000 pages to put whatever you want in there. And then you can look at your congressional base and say, because I know a lot of people are picking on this bill as like a tax cut for the rich. If these rates had expired, this would have been a big tax increase.
No, they're not saying what they're saying, and this is both true and not true at the same time. True and no, it's true and but yet disingenuous. What they're saying is that this tax legislation favors the rich. Well, of course, because the rich make more money. So let's say let's look at it this way. Let's take someone who makes $1 million a year, and you cut their taxes by 1%.
That's $10,000.
All right, it's $10,000. Now let's take someone who makes $50,000 a year and cut their taxes by 50%. You know, like, well, let me just
cut their taxes by 10%.
Yeah, 10%.
It's $5,000.
Yeah, it's the same equal tax break for each person, but it disproportionately helps the wealthy because they just have more money.
Well, so but I guess what I'm trying to say is, look, for typical people, the old tax system had more aggressive tax rates. They were paying more in taxes pre-TCJA than post. And these brackets were set to expire.
Mm-hmm.
So what would have happened had this bill not been passed is that all of the tax rates would revert to what they used to be.
Yeah.
The 12% rate goes to 15, the 22 goes to 25, the 24% bracket goes to a 28% and a 33% bracket. So this was going to be a big tax increase. So in this quote big beautiful bill, I think the president was able to look at Congress and say, look, you may not like everything in this, but if you don't vote for it, you're going to be voting for the biggest tax increase in a long, long time. Right. And so it got through. And one of the most, I think, important provisions of this for the vast majority of the people that we talk to is simply the extension of the existing tax brackets.
Well, and actually in a questionable move by the Senate, I actually think is quite genius. They were able to assume the TCJA tax rates as the baseline, so they weren't considered as part of reconciliation. So what basically that means to you all is that the personal tax cuts that were passed in 2017 under reconciliation that were set to expire are made permanent.
They're now permanent.
They're now permanent. Now, a lot of the House looked at it and they thought, we're not going to do that because technically the baseline was what was passed prior to that. You know, were the brackets the 15%, the 25%, the 28 and 33, the ones that you mentioned were the baseline. The House assumed that was the baseline, whereas the Senate didn't. And then the total bill assumed the Senate's way of looking at it.
And so this was a big, it feels like it's not tax savings because it really doesn't change where you were last year. It's like he's just keeping the existing brackets.
Yes.
But this was the biggest probably win for a lot of our clients, just looking at what would their tax bill have been if that had expired.
Well, think about it like as if the Titanic missed the iceberg. You know, all the people on the ship would have not known. You know, we're all on the Titanic heading right for that iceberg. And now, you know, the ship managed to steer away from the iceberg and everybody's just having a hunky-dory time, not realizing, you know, the catastrophe that was avoided.
So I think one of the more bland pieces of this bill, but it shouldn't go without mentioning, is that we are keeping the current income tax framework and brackets.
Yeah.
I think that's on its own a really
with a couple of caveats, if you'll entertain me here. So one, which benefits small business owners, is the QBI deduction, which is known as the 199A deduction. Essentially what it amounts to is this. So let's say you're self-employed. You make $200,000, your business does, and then you pay yourself that $200,000 as self-employment income. What the IRS allows you to do is you can deduct 20% of $200,000 for $40,000. So now the IRS says, we're just going to pretend you only made $160,000. That is what's known as the QBI deduction. So the reason why that was passed is because self-employed individuals have to pay both parts of the self-employment tax, which is, you know, FICA tax, which is like 15.2%. But anyway, the corporations got that permanent tax rate at 20%. So, you know, the Congress basically passed this olive branch to self-employed individuals who don't get that favorable tax treatment.
The corporate tax rate that a lot of people like to focus on is so low. It's only paid by what's called a C corporation.
Yeah.
Every other most small businesses that you interact with are not C
they're
corporations.
They either, you know, are sole proprietorships, LLCs, S corps. But
the point is, this was meant as a levelizer. So House passed first version of the bill.
Yep.
Goes back to the Senate. Senate rips it up, says, you know, basically tells them to take a hike, shoves it right back to them. House then passes a new version of the bill, goes to the Senate. Senate then passes what they consider the last version, and then they go home. They left. It's the proverbial, you know, I'm going to make you an offer, and if you're not cool with it, that's great. I'm going to walk out the door.
Yeah.
And the Senate all walked at the door.
So
and
the
said,
House is it's either my way or the highway.
This was and the kind of self-imposed deadline from the Republicans was July 4th.
Yeah.
Okay, so this was the week before July 4th. Senate passes the bill, needs to go back to the House to be passed, and the Senate leaves. And everybody in the House knows Trump wants this bill passed by July 4th, and that the Senate can't come back to vote on this thing until after July 4th at this point. So they had their hands a little tied at this, and then it ended up getting passed. Then Trump signed it on July 4th, whatever. Extends the current tax brackets, extends the QBI
Makes it
deduction
permanent.
components, increases child tax credits. If you have children and you're qualifying dependent, you now get an extra $200 per child per year.
I read that was the increase was temporary though, and the increase ends in 2020.
There's a lot of things in here
Yep.
that have expiration dates. So,
Yep.
for example, going down the list, the Trump accounts that we talked about earlier, you get $1,000 from the government for having a kid. Well, that only goes for a couple of years, right? There's a new deduction for interest on auto loans if your income is under certain thresholds, only for the next few years, only on cars bought since January of this year. So there are a lot of things in here. One of the biggest, actually probably the biggest one, is this, and we should spend some time talking about this. So let me back up a second. Since the passage of the bill, I've been talking with clients and trying to get my head around, like, where are the plan? How do I help take these rules and translate them into bottom line dollars for our clients? And one of the things that there's a couple of like key planning areas, but one of the big ones is this new state and local tax cap. Okay. So backing up, I know I do a lot of kind of backing up to help educate and set the stage. But when it comes to your tax return, your personal tax return, there's kind of two sections. Section 1, you add up all of your income. Section 2, you take one of two pathways on a deduction. One pathway is called the standard deduction. The other pathway is called itemizing.
Which that was increased too permanently. The standard deduction.
The standard deduction was increased, and so the standard deduction is pretty high for married filing joint. I think it's like $31,500.
That's right.
So once you've added up all of your income, you now have two pathways to choose. You can either get the standard deduction, let's just say married filing joint, $31,500. This assumes you're under 65, married filing joint, whatever. And then pathway 2 is itemize. Which pathway you choose is going to be whichever one gives you the most tax savings, whichever one's the bigger deduction, right? So then you have to ask, well, what things can I itemize? Things that are on that list, the big three: mortgage interest on up to $750,000 of mortgage on a primary residence, state and local taxes, which before this bill, they were capped at a $10,000 maximum. So you could pay $100,000 of state and local taxes between property taxes, income taxes, whatever it is. You only got to deduct $10,000. And then charitable. Like, those are the three big ones. There's a couple of others, but those are the three big ones. So what happened was that $10,000 cap on state and local taxes was increased up to $40,000 with the caveat. And here's where they increase, again, more complexity. If your income exceeds 250 single, 500 married filing joint, you start to phase yourself out of that higher state and local tax deduction. So your $40,000 maximum goes all the way back down to $10,000 as you add income. This is another huge deal because for our clients that are married filing joint with more than $500,000 of income, from that $500,000 mark up to about $600,000 of income, when you add their tax rate that they're paying plus the incremental tax because they are pushing themselves out of the ability to deduct their state and local taxes, their combined federal tax rate reaches between 42 and 45%. It is the highest tax rate that I've been able to find. You could make $5 million a year and your 5 millionth dollar is not taxed as heavily as your 550,000th dollar because of this. And I just think there's going to be a ton of planning opportunity around this because a lot of the clients we work with have more than 10,000 of state and local taxes, maybe less than 40. And so what we're having a lot of conversations around is how can we strategically
so
push
really
these expenses
the trigger for this would be like if your income is over $500,000. So if your income's over $500,000, you should be assessing, what are you doing?
Well, I think there's a lot of implications to this, right? So like one is planning around just income, right? If you're over $500,000 of income and you can take deductions,
Mhm.
like you can reduce your income, those deductions are really powerful. I think if you're under $500,000 of income, but you pay more than $10,000 of state and local taxes, and maybe you wouldn't be itemizing otherwise, there's now opportunity to what's called bunch in our industry, where you concentrate deductible expenses into 1 year. So let me give you an example. Let's say your property tax bill is $20,000 a year. Okay. And in Ohio, property taxes are roughly 2% of the home value. So let's say you have $1 million house, you're paying $20,000 a year in property taxes.
Mhm.
That's split up into two halves. One of those halves is due at the beginning of January, other one in the middle of the summer. What you might do is, instead of paying property tax bill in January and June and then next January, 1 year you might pay property taxes in January, June, and then December, and go ahead and pay next year's taxes this year,
Mhm.
therefore concentrating $30,000 of property tax into 1 year and really juicing the amount of deduction you can get that year by kind of taking that deductible expense from the next year. Thus, the next year, reducing the amount of itemizable expenses, which not a big deal because you can take the standard deduction. So we will put together a bit of a visual on this and put it in the show notes for you. But in talking with clients, I've found that I think one of the bigger planning opportunities here is how to take these state and local taxes, which are now capped at $40,000, with a already pretty high standard deduction, and do planning.
Keep in mind though
to
that
push these expenses
there's an income phase out for that. So I think
It's 500,000. We just talked about it.
500,000. Yeah.
That's
So-
what I'm saying. So for a lot of retirees, I mean, a lot of retirees we work with, their income is not necessarily 500,000 because they're just living off of their savings, and they might have a paid off house. They might have
Mhm.
two paid off houses.
Yeah.
And all of a sudden, they might have $20,000-$30,000 a year of property tax. And if there's a standard deduction of 31,000, and every year they're just paying their normal property tax bill, they're never getting any benefit for those tax deductions. If we're able to take some of those taxes and concentrate them in 1 year and get to that $40,000 cap, we might actually be able to itemize some years and get some real benefit from that.
Yeah. Well, I think that pretty much sums up some of the major components of the tax, the tax portion of the one big beautiful bill. There's a lot of other stuff that I don't know if we want to get into. There were quite a few cuts to Medicaid.
Well, charitable. I think
mhm.
we've talked a lot on this podcast about charitable. There's some really interesting changes that'll impact the way that we approach charitable planning.
Well, yeah, the one of those cool changes I thought, which is going to really help a lot of charities, because one of the major problems, well, it's not a problem per se, but one of the major kind of bummers is most people who give to their charities or local church or what name you, generally they use a standard deduction because it's so high, so there's no tax benefit to donating to charity, especially at Goodwill. Think of, like, donating stuff at Goodwill. Most people don't even bother with the receipt because they're like, well, I'll take the standard deduction anyway. As I understand it, the way the bill is written is that you actually can take up to $2,000 on top of the standard deduction for charitable contributions.
Yeah, so there's a new rule,
Mhm.
and I think this is you're hitting on it exactly. In the
Mhm.
Tax Cuts and Jobs Act, because of what we just talked about, this higher standard deduction, and the fact that charitable expenses are typically an itemizable deduction, which doesn't matter if you're taking the standard deduction. There was a bunch of people donating, getting zero tax benefit. So new rule says if you are taking the standard deduction,
Mhm.
you can take $1,000 single, $2,000 married filing jointly as a charitable contribution
Mhm.
for money donated to charity in
Yeah.
excess of your standard deduction. So that's going to be, that definitely puts a little bit of a tweak in how we do some of the charitable planning, because we do a lot of concentrating charitable stuff in one, these item in years where
I don't
clients
know.
itemize.
I don't think so, because the situations where we use donor advised funds, you're typically you're talking about major charitable
No, I agree.
donations.
I agree. But like, if you think about it this way, like,
Mhm.
I'll give you a great example. Client is going to retire, is 60 years old, and they're
Mhm.
going to retire.
Mhm.
And this year is the last year they're going to be in the higher tax, but let's call it the 32% tax bracket.
Yeah.
And we want to do a and we want to do a charitable contribution for the next 10 years, right? They're going to take Social Security at 70. So maybe for between 60 and 70, they're not going to have so much income. And so the deduction to charitable is more valuable in the year where they have the higher taxes, right?
Sure.
So we might take 10 years worth of donations, put them in a charitable account called a donor advised fund. And the benefit of that is without having to give the money to the charity yet, you can take the whole deduction. But again, that's if you itemize. There's going to be, in this example, now for those next 10 years where this pretend client is taking the standard deduction, there's an extra $2,000 allowed for charitable. And that money can't come from a donor advised fund. So I think it will tweak a little bit. When you think about funding a donor advised fund for 5 or 10 years, it may end up being beneficial to think about how that extra 2,000 might compare. And maybe that's a bad example because, I think if they're going to be in a really low tax bracket with that 2,000, you may still take it at 34. But I definitely will, as I'm setting up these charitable accounts for clients, if all else equal in their tax rate, I can take some as an itemized deduction in 1 year, but then add some to the standard in other years. That's probably worth looking at.
Well, either way, it's great for charitable funding. I'm a big fan of that portion of the bill because it was always kind of a bummer. Now, you shouldn't be given to charity for the tax break anyway, but a lot of people do like that extra benefit of giving to charity. So there were, as I said, a lot of provisions in this bill that we're not going to have time to get into today, nor should we, because they're not necessarily germane to your financial wellness. But I will say that there's been a lot of heat around the whole Medicaid cuts. One thing I will caution is I've had to field a couple questions on this. There is a big difference between Medicaid and Medicare. All right, so do not conflate the two. So as I understand it, there are no cuts around Medicare, nor are there any cuts around Social Security. I've had a couple clients that are very concerned about both. So I'm not sure what's out there. There's certainly information that is hyperbolic, but anything that references cuts to Medicare or Social Security, I would disregard because I've yet to see a reputable source that references any cuts to either program. That's not to say you shouldn't be concerned about Social Security because it's Social Security OASDI fund is still set to run dry in 2032, I think. So that's something we'll probably talk about a different episode, but that was not touched on in this bill. Medicaid, however, was. So Medicaid is a health and wellness benefit program given to those who are below a certain income threshold. Generally speaking, you need to be below the federal poverty line to qualify for it. So, there were a lot of provisions placed on Medicaid in order to receive it. One of those, as I've read it, is you have to, if you're an able-bodied person, meaning not disabled, and you don't have dependents under the age of 14, then you have to either volunteer or work for 80 hours a month to retain your Medicaid benefits. And there was also a lot of other provisions that I don't fully understand, but a lot of this, the tax extensions were funded through cuts to the Medicaid program. And there were other cuts in other areas, but I didn't see. I think that was the major one. There was also a fund set for rural hospitals, which I found to be. It sounded like a lot, but when you really think about it, it's not. It was a $50 billion fund established to kind of rescue in trouble rural hospitals that would be detrimentally impacted by the cut to Medicaid. But if you think about it, there are a lot of rural hospitals out there. How much do you think it costs to run a hospital?
I would imagine that the job of a hospital administrator. It's like I've seen enough medical bills with like insurance coverage to know that like the billing has to just be a complete
it's
nightmare.
Gotta be a nightmare.
I can't imagine trying to run
there's
one
a
of these
whole
billing
college degree for medical coding.
Hospital administration or whatever.
No, there are literally. I have clients that do this for a living. They went to school. I think it's a 4-year program to learn
Billing codes.
Billing codes. It's talk about it. Cottage industry. My word. Like
Yeah.
really? So we have.
I think you could probably like if the profit margins of a hospital are as transparent as their bill, I could tell you they're somewhere between 0 and 50%. You know, I mean,
Yeah.
it's like that. I can't imagine the level of complexity that goes into, you know, that revenue recognition.
Well, I think that the $50 billion to rescue in trouble rural hospitals is probably not going to be enough. So we'll continue to see rural hospitals struggle, but you know, there was also a small amount assigned for like the Kennedy Space Center, I think. But anyway, we covered
you paid more attention to. I mean, from my perspective, I want to make sure that the clients that we work with are taking advantage of these strategies. And what I've learned is that because of the added complexity of these, it is different. Like how you apply these to client situations is different for each client. Some clients you're managing them around that phase out for state and local taxes. Some clients you're trying to make, you know, concentrate deductible expenses. Other clients you're trying to manage Social Security phase outs, senior deductions phase outs. All of this put together with Medicare thresholds, Medicare premium thresholds, RMDs, Roth conversions. If you are a retiree, you know, I think one of the most common conceptions is a retiree looks at me and says, my situation's really simple. I've got Social Security, maybe not a pension, you know, a retirement account, maybe a non-retirement account. It's pretty cut and dry. And yes, it may be simple in the sense that there's not like a whole lot of accounts out there and what have you. I promise when you look at the taxes, it's not as simple as you think.
Yeah.
And there definitely are things that you should have an awareness on where your income sits relative to some of these phase ins, phase outs, and be able to articulate a plan around how you either strategically recognize income to be able to not recognize as much later, or strategically defer income to recognize more later.
If you care about what your bill to the IRS is and minimizing that, you do not have the luxury of saying to yourself, I do not know what my adjusted gross income is.
You should know that.
You need to know what it is, and you need to know ahead of December 31st. You know, not just April 15th. You got to know where you're going to land prior to the end of the year.
Yeah, we're already doing tax projections. I mean, basically, as soon as this bill passed, I mean, I was in the tax planning software starting to build out client scenarios. And now what's happening is I'm sending like some essentially draft scenarios to the clients to get their sign off on like how correct are some of these, like, did I miss something here? And we're going to be able to use that as a really good talking point for a lot of the tax planning that we're doing in like September.
Yeah.
And it needs to be in September or October because you need time to implement these things. Like if I work with, let's say, a business owner, one of the things we didn't touch on in this podcast is business owners are now going to be able to use what's called bonus depreciation.
Oh yeah, I forgot about that.
And bonus depreciation allows a business owner to buy a piece of equipment or machinery, and whether they finance it or not, which is key here, they can take a whole tax deduction for it up front. So if I buy a piece of equipment worth $100,000 and I finance it for $2,000 a month, I get a tax write-off today for buying the equipment worth $100,000. So that tax write-off might be worth $20,000 or $30,000, maybe more in my pocket. And I didn't come up with any money on day one. I just have a $2,000 a month payment.
Yeah.
And so that's really stimulative, but great to say. It's hard if a business owner looks at you 2 weeks into December and says, hey, what can I do to reduce my taxable income? And you're talking about bonus depreciation. Like, go buy a piece of equipment over the next 2 weeks. Like, good luck. You know?
Yeah,
it's
for sure.
It needs to be planned out.
Yeah, it does. Yeah. So now I do want to bring this to the final conclusion as we wrap up this episode. And that is what this legislation means is more money in consumers' pockets. And that is very stimulative to the economy. And that ultimately is going to lead to assets flowing in, or dollars flowing into financial assets. So it's hard to look at this and look at the backdrop of our current economy, with, AI. You mentioned some AI announcements. I don't know if you
Google
touch on
announced
that.
today
Yeah.
$25 billion invested in AI
Yeah.
infrastructure.
By the way, I got to take quick research project for everyone listening. All right. The doomsday scenario around AI is overblown. I was looking at Joe Rogan has these guys on, these AI people on, and then he had these two clips, JRE clips. You can look at them up on YouTube. He has two of them stacked up right on top of each other. One that says AI worst case scenario, AI best case scenario. All right. The AI, I listened to both of them. AI best case scenario was the more coherent argument. It wasn't even close. It was like, yeah, I can get behind that. That sounds like what it's going to be. And for those of you who are interested, just go look it up and listen to it. But the views on the best case scenario versus the worst case scenario was 10x higher for the worst case scenario. So everybody's just freaked themselves out about AI. AI ultimately, bottom line, it's going to boom the economy. If it ends up being what everybody says,
or it'll kill us all.
No, it's not going to do that. It's not going to kill us all. I don't.
I think this is a good topic for the next.
Yeah, it is. We'll move on from that
podcast. But
bottom line
your point is we are, even though the scenarios that are, and we see this in financial planning, just to bring this back to clients. A lot of the clients that we work with have an overwhelmingly positive financial situation, right?
Yes.
Like, assuming that they continue to, they don't get hit by a bus and they don't become disabled for some reason. Like, as long as they're able-bodied and keep their head on straight, like, they're going to make income. And that income is going to be, as long as they can save some of that, like, they're on track to being wealthy. So let's say I run a financial plan and it says there's a 95% probability that you're doing just great.
Yeah.
They still want to focus on the 5% that screws up. There's so many, I think it's human nature to live
in fear,
in fear, right?
Yeah.
And react to, even though it's lower likelihood type scenarios, they're scarier.
Yeah, they
right.
are.
And most of the clients that we work with on a financial plan, what's so funny is they spend a lot of time thinking about those really bad scenarios. In the grand scheme of things, there's a lot more likelihood that they're going to have a good scenario, and they haven't spent as much time thinking about that. So I'd love to unpack that on another episode.
Yeah, we're going to, but I think the point I'm making, and you agree with this, is it's hard to look at the backdrop of everything going on and see a recession. I think that the most likely, the next 3 to 5 years mostly looks like economic growth.
You've got lower taxes. You've got investment being made into big infrastructure investments. Infrastructure generally is, once it's invested in, you've got essentially more infrastructure to do business. I mean, I would agree with you that it doesn't seem very logical that we would have some, you and I have both agreed on this for a while. I don't think we're in a position to have some massive recession. I think we could have some technical recession on, maybe some, GDP technically lower for 2 straight quarters or whatever on some, but fundamentally speaking, you have too many consumers that are aging into, I've talked about this a lot on this podcast. There are 74 million millennials, give or take. Only 71 million boomers, give or take. Millennials are aging. We are in our household formation years. And name me something that is more beneficial for the economy than millennials buying houses and having kids. And I know everybody's giving a hard time to, millennials aren't buying houses as much and they aren't having kids as much.
Crap. I saw an article on Fortune about that. I sold my house recently, and I know we got to wrap it up here, but I sold my house recently to a nice couple that were millennials. The people that are buying homes, they're like 80% millennials.
If you looked at the goods and services and how things went as like the baby boomers aged, it's like the economy followed them. It should be really obvious to all of us that that's going to happen with millennials. Like there's so many of us that as we go through our lives as millennials, what you may notice is that the advertisers are going to cater to you, the healthcare, like there's no surprise that, if you watch like local news, majority of the ads you see are like medical care, right? Because they're marketing to baby boomers, right? And millennials as a cohort, there's a ton of us. We're getting into our peak earnings years. We're getting into peak household formation years. Those things are really good for the economy.
Absolutely.
And I don't care who's president. If I have a kid, I'm still clothing my kid, still feeding my kid. I'm still educating my kid. People think that the economy is way more elastic than it actually is.
Yeah.
Right. Presidents have some control, and maybe Trump has had more control than any other president that I've seen in my life with the way that he's gone about it. But at the end of the day, you wake up and you live your life.
That's right. Yeah.
And you're not gonna not do that because of who's president or whatever tariffs or whatever.
No one wakes up and says to themselves, no one normal that is, and says, I'm gonna make my life worse today.
Yeah.
It just doesn't happen. But all right, well, on that, I think we'll end it. I appreciate everyone sticking with us as we discuss and unpack all these complicated things. If you're looking for a more detailed analysis on your tax situation, I encourage you to reach out to either Brent or myself, and we're happy to do that for you.
Yeah, we have an email in the show notes. If you have any questions on anything that we've talked about, or just any suggestions for topics that you'd like to hear about, feel free to submit them. Reach out. We would love to hear from you.
Catch you next time. Opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Investing involves risks, including the potential loss of principal. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Advisory services offered through National Wealth Management Group, LLC.